You can have inefficient markets because there is irrational behaviour exhibited by humans trading in the markets. The mere existence of irrational behaviour does not necessarily mean that a market is going to be inefficient. There has to be some reason why smart investors don't push prices to fair levels. You can also have an inefficient market without irrational behaviour due to market frictions like taxes, transaction costs, administration costs, and a lack of perfect competition. But irrational behaviour can be one trigger for an inefficient market. The irrational behaviours described below are present in retail investors and institutional investors, but are much more pronounced amongst retail investors. The first trait is overconfidence. Humans are overconfident. Research shows that more frequent retail traders earn lower returns than less frequent traders because they incur transaction costs without forming higher return portfolios on a pre-transaction cost basis. Aside from trading, human beings in general exhibit overconfidence. For example, young males drive too fast. The class has a number of young males, and a 20-year-old male pays 17% more for auto insurance than a 20-year-old female. The gender gap shrinks to around 0 for older drivers, but young drivers in general pay much higher premiums than older drivers. In terms of driving skill, there is reason to think that young drivers should be better than older drivers. They have better eyesight, better reaction times, better skill in many technical athletic areas. The ability to throw a football, the ability to hit a golf ball or hit a tennis ball should translate into a better ability to drive a car. But ability is less important than judgment and overconfidence. The young male driver knows the speed limit is 70 miles per hour, but believes he can drive safely at 80 miles per hour, even in adverse conditions. The older driver knows the speed limit represents an estimate of the maximum safe speed in good conditions. So young male drivers have more accidents, and they have accidents at higher speeds, thereby causing more damage. Insurance companies understand the relatively high damage from overconfidence and account for it in insurance premiums. As another example, marathon runners run the first half of a marathon too fast. The vast majority of marathon runners run slower in the second half of the race than the first half. This occurs because of a depletion of glycogen, an energy source stored in the legs and liver. But even marathon runners who have done this over and over again repeat this error. They start too fast, deplete their stored energy, and slow down. Why? It's detrimental to performance because the time the runner loses in the second half is much greater than the time gained from running fast early. The faster the early pace, the bigger the crash. Why the repeated mistake? Because they start the race and say, today is the day. Despite all the data that I have on training and my past results, today is the day that I go 5 minutes faster than the data suggests. And then they run the second half of the race slower. Something happens on the start line that triggers overconfidence, which leads to runners being consistently surprised by the adverse outcome. Now consider market participants. Returning to finance, investors can exhibit overconfidence. Survey evidence suggests that investors have beliefs which underestimate the risks associated with trading. This can trigger mispricing because it leads investors to retain investments or increase their holdings regardless of the negative information that suggests that they sell the investment. It can also lead to investors paying more attention to trends in past prices on the basis that the past price movement in their mind is predictive of future prices. The next example of irrational behaviour is regret. Crystallising a loss makes investors experience regret. Researchers have measured which stocks investors buy and sell, and the data shows that investors sell their winning investments too early and hold on to their losing investments for too long. For example, suppose an investor had bought stock A for $90 and stock B for $110, and now both stocks are trading in the market for $100. Stock A is up by 10%, $10, and stock B is down by $10. The research shows that the investor is more likely to sell stock A and hold on to stock B in the belief that stock B's price will return to $110. By selling stock A, the investor feels that the investor has made a good investment. But the outcome for stock B at this stage, in the investor's mind, it's still unknown. It hasn't been crystallised. If we were keeping score, we know that the investor is in a neutral position. But the investor can believe that the profit is $10 today, ignoring the loss on stock B. This can lead to a market inefficiency because there is less trading on the basis of objective information, which will push prices to a fair level, and more trading on the basis of a behavioural bias. Let's consider the second way that we try to minimise regret, or that we could lead to us experiencing regret, investors selling their winners too early and hanging on to their losers for too long. And that is reference bias, which I briefly alluded to earlier. Investors believe that the price that they pay for a security somehow matters for the security's future price. Suppose an investor bought a security for $100 and the price is now $80, and the investor plans to wait until the price reverts to $100 before the investor sells the security. This is a reference bias because the investor believes that their own $100 purchase price is somehow a useful indicator of what other investors will pay in the future. This belief exists despite the potentially thousands of trades in that security. The third behavioural bias, or evidence of irrational behaviour, is familiarity. Investors like buying stocks they are familiar with. Retail investors in particular exhibit this trait, so they'll buy stocks like Apple, Lyft, Netflix and Facebook. This doesn't necessarily mean they have insights into whether the purchase price for Apple is above or below a fair price. And it doesn't mean that retail investors really understand the business model of Apple. At a high level, we all understand that Apple sells smartphones and computers and has a manufacturing base in China. But that doesn't mean that we understand the intricate supply chains involved, the competitive environment, consumers' price sensitivity, how troubling it is for the consumer to switch from an Apple computer to a PC, what this means for earnings projections and how this will flow through the share price. The implication of this familiarity bias is that retail investors are more likely to buy investments that have good news headlines today, and in companies that have a business model that they believe they understand at a high level. This can reduce the impact that objective information has on asset prices. Finally, investors overweight recent personal experience in decision making. Investors' decisions overweight information that is recent and has been personally experienced. And the reason this occurs is that humans' decision making is greatly affected by stories, which carry a disproportionate weight in decision making compared to analysis of large data sets. This can be one catalyst for an asset price bubble, like the technology or property bubbles, because the investor's recent experience is that asset prices go up. All markets, shares, bonds, real estate and others, have a degree of inefficiency. Behavioural biases can be a catalyst for an inefficient market, but on their own are not enough. Even if many investors exhibit irrational decision making, prices will revert to an efficient level if there are enough rational traders who can exploit behavioural biases, trading the opposite manner to biased decision makers, provided that the rational traders have the capacity to trade without constraints on capital, liquidity and regulation. In contrast, markets are relatively more inefficient if rational traders have limited ability to exploit individuals' behavioural biases. Market frictions, a term for any market characteristic that impedes trades, both create the opportunity for asset prices to deviate from fair value and impede the ability for information to shift prices towards fair value. 3 important market frictions are costly information, incomplete markets for trade, and unlimited access to capital. I consider these market frictions below in the evidence on market efficiency. But as an overview, if information is costly, both in terms of direct purchase costs or on-the-ground information gathering, such as viewing a property or interviewing informed people about business prospects, and the time, wages and computing expenses needed for analysis, there will be fewer investors trading on the basis of this costly information. If markets are incomplete, for example, short selling constraints represent an incomplete market, the prices could reflect only one view rather than being a mix of optimistic and pessimistic investors. And if there is limited access to capital, it means that investors might need to close out a position at a loss prior to their predictions coming true, even if those predictions were well informed and turn out to be correct. In the upcoming discussion, we're going to talk about the evidence as to whether the share market is semi-strong form efficient.